Good afternoon, everyone. Today we're going to discuss one of the most significant economic events in modern history, the Great Depression of 1929. Now, if you think recessions today are bad, what happened nearly a century ago was on an entirely different level. Let's set the stage. The 1920s, often called the Roaring Twenties, were a time of economic boom in the United States. Factories were producing goods at unprecedented rates, people were buying cars, radios, and refrigerators on credit, and the stock market. Oh, the stock market was on fire. Investors, both big and small, believed the market would only go up. People were borrowing money, often as much as 90% of their stock purchase price, just to invest. This is what we call buying on margin. But here's the thing, when everyone's chasing easy money and ignoring risk, trouble isn't far behind. By mid-1929, cracks started to appear. Companies weren't making the profits investors expected, and stocks were grossly overvalued. On October 24, 1929, a day known as Black Thursday, panic hit Wall Street. Investors began selling stocks at a frenzied pace, and the market plunged. Just days later, on October 29th, Black Tuesday, the bottom completely fell out. Stocks lost billions of dollars in value almost overnight. Now let's talk consequences. When the market crashed, it wasn't just about stocks. Banks had invested heavily in the market too. As stock values plummeted, banks started failing, one after another. People rushed to withdraw their money, causing even more bank failures in what we call a bank run. But most people couldn't get their money back. It was gone, wiped out, unemployment skyrocketed. By 1933, nearly 1 in 4 Americans was out of work. Families lost their homes, farmers lost their land, and entire industries collapsed. Soup kitchens and bread lines became symbols of survival. And this wasn't just an American crisis, it spread worldwide, triggering economic downturns across Europe, Latin America, and beyond. But every crisis teaches us something, doesn't it? Out of the ashes of the Great Depression came significant reforms. In 1934, the Securities and Exchange Commission, SEC, was established to regulate the stock market, prevent fraud, and ensure transparency. Laws were passed to protect bank deposits, leading to the creation of FDIC insurance. So, what's the lesson here? Excessive risk, unchecked speculation, and a lack of financial oversight create a ticking time bomb. The Great Depression wasn't just an economic failure, it was a failure of systems, policies, and human behavior. And if there's one takeaway I want you to remember, it's this. Markets thrive on trust, but they collapse on fear. Alright class, that's all for today. Next time we'll dive into the 2008 financial crisis. Another story of risk, greed, and lessons learned, or maybe not learned.